But for now, we'll leave you in the good hands of our moderator. He's the head of research at SAC Capital, Mr. Matthias Chan. Please welcome our speakers and moderator.
Hi guys. All right, we're going to introduce ourselves a little bit. So I'll be moderating this session. My name is Matthias Chan. A bit of background, as you can see, not youthful, so no spring chicken. I've been around for a bit, more than 20 years with UBS, Nomura, Commonwealth of Australia, KHN is part of it as well, Mirae Asset, and now I'm with SAC Capital. That's a boutique investment banking firm. Okay, that's enough of me. Paul?
I'm head of research at Philips Securities.
Come on, and before that?
Prudential, Taiwan, UOB, BNP, yeah.
Okay, so a very big part of the Singapore history as well. Okay, then, Gerald?
I only have one, which is Credit Suisse. So I was at Credit Suisse for 13 years. I left in 2021. Before I left, I was heading up the Singapore equity research team in Credit Suisse. Since then, I've started my own firm, Beansprout, and what we want to do is to help you make better investment decisions. And these insights can be found on our website, growbeansprout.com.
Right. Pearly.
Hi, I'm Pearly. I'm now a private investor. I used to be both a sell-side research analyst and then a buy-side fund manager for over 20 years. When we were having our gathering coming in here, I met some of my old friends like Paul. You know, we've known each other for, I hate to say this, but over 20 years. So I guess we've seen the cycles, and hopefully today we can make some, help you all to make some informed decisions on how to react to cycles as well. Yeah, thanks.
Great. Okay, let's do some hard stuff. Okay, for a start, maybe we look at the market as a whole. The last 1 month has been exciting, to say the least. Fortunately, on the negative side. So, with what's happening, what we talking about recently, SVB, and then of course Credit Suisse, in overnight, the CDS, your insurance swaps for Deutsche went mad as well. So it's a lot of disruption. Can we just go down and maybe you can, help us to wrap our head around what's going on and the implications on the market in the foreseeable future, in the short term?
Okay, I guess for us, I think what has changed is probably interest rates has peaked. Why we say that is for the banks, at least on the asset side, with the risk of recession, they're obviously going to pull back or at least not refi, that's the risk. On the liability side, they probably want to keep their deposits as liquid as possible. So all this means there's going to be tighter credit conditions. But of course, credit is only on the loans. It's harder to predict what's going to happen on the security side, but we can expect that to also tighten. So this all means that while global growth was already sliding, this will probably kind of accelerate the situation.
I think if we try to connect the dots between the few events, SVB, the Swiss bank, Deutsche Bank, I think the genesis really comes through from the increase in interest rates that we saw over the past year. I think that is one very important aspect that every investor needs to be aware of because it has effectively changed the macroeconomic landscape very significantly and how we think about different asset classes, how we want to actually be allocating our portfolio. I think what we do need to understand is that while there are some expectations that interest rates may come off a bit if the risk of recessions become higher. Overall, we are probably not going back to the days where interest rates were at very low levels. And hence, I think that is going to shift how we think about how we invest in different markets, how we invest in different stocks.
Maybe I'll just add. So I agree that a lot of it stems from the global monetary policy. If you take your minds back 10 years ago, I think we've had a very, very long-term period of very loose monetary policy. And until inflation bore its head post-COVID, the Fed had no choice but to accelerate its interest rates incline. And it's not so much the increase of interest rates as much as it is the speed of the increase of interest rates. And because it has been so accelerated, all these issues have come out in the banking system, for example. And so now I think at this juncture, if we talk about sentiment, it is very weak and vulnerable. And we have also in the new era, social media has played a very important role. So I think for investors today, you do need to be very conscious of what's happening in the macro landscape, understand and listen to the news on what the Fed is planning to do. It's very, very macro driven in my view. The other thing is also, I do think that I think it's fairly consensus that we are going into a recession globally, especially in the US and Europe. So I think, taking an investment stance that was more cautious and also looking at it over a longer period of time is probably more advisable. Yeah.
Okay, so one of us says that interest rate he thinks he has peaked, but there's fear in the market, there's volatility. But, it's easy to be paralyzed by fear. And as Paul's Kopi companion called Warren Buffett, he says that, you should buy when everyone's fearful, right? So I think fear is quite there. Of course, we'll never know whether we are at the epitome of fear or not. So what do you see happening in the market for the rest of the year? Hold back because there's still some more volatility, there's some more downside, or it's crazy out there? Let's start dipping in. What do we think?
Oh, okay. I shouldn't have said so. Yeah, that's yeah. So I think the general picture, firstly, is that for us, I think we are favorable towards REITs because if you have an environment, if we assume the environment is rates have peaked, things are slowing down, then of course the best place to be is park where anything that looks like a bond, walk like a bond. So that will be REITs. Obviously, don't expect REITs to grow. Okay? So they still have a big headwind of high interest rates, but nevertheless, stable rates is good enough tactically. Was that a question? Yeah. Okay. Yeah, so that's how we would position in investors, because the macro environment, if you look at exports from Singapore, Taiwan, they're all collapsing as well. It's like they all have the same chart, just sliding down sharply. So just that before you get the rebound, you're going to have this wave of slowdown. The only thing is the unknown is just that if the Fed does say they're going to pause, so how would the market react? So there could be maybe one shot rally when they mentioned that. Then the journey before they cut rates could be harsh on the market.
Okay, so to recap the question, Paul, is there still fear? Is there still downside, and so we hold back, or do we come into the market and if we do in an aggressive way, or touch in the field? Okay,
just a very short stat. Okay, in a typical recession, you look at GFC, or COVID, the typical peak to trough in the US roughly 40%. Normal recession, mid-teens. So the US is about 17, 18. So we kind of have already priced in some of this recession, unless it's a really deep depression, some major exogenous shock, which we don't think so. So there is already some pricing in by the market. I mean, I think you ask any auntie on the road, they still can tell you, yeah, recession, we heard about that. So it's kind of priced in by anyone.
Maybe I can add. So if you look back at the data in the US, and taking the lead from the US, back in the 1920s until now, and all the past periods of recession, recession periods on average last about 18 months. 18 months on average. So, there's a range, but it's about 18 months. And during the recession, what happens is the earnings of companies will fall, right? That's natural. And on average, I think the earnings of companies fall like maybe about 18% or something. But markets always trough before the recession ends, right? Markets always trough before a recession ends. Why? Because markets always anticipate. And the tendency is to anticipate about 2-3 quarters ahead. So if you think that the recession is going to last on average about 18 months, right? we would want to be investing in a market sometime, maybe in the second half of 2023. Because how long has the recession been now? Maybe since first half of 21?
Weakness since the end of second half of last year.
Yeah, so first half of 21 until now, right? So, it's during the second half where you start to see maybe things settling down. So you never wait for the worst part of the earning cycle. You're always projecting, you're projecting ahead. Investors always project ahead. Of course, at the end of the day, as a retail investor, standing on the outside, it's very, very difficult for you to time. Markets are terribly difficult to time. So, one way is to tread cautiously and average down over time. That's one way, yeah.
I think I can also offer another perspective since today's topic is about investing in the world's growth driver, which is Asia. While we spoke a lot about the US interest rate hikes, maybe I can offer another perspective, which is looking at one potential positive driver of the market, which is still China. If you recall, just about 3 months ago, everyone was very excited about China's reopening. They pivoted very quickly from the COVID-0 situation. And I think we have not fully seen the impact of China's reopening to the global economy as yet. So for investors who are thinking maybe a bit longer term, can withstand some of this near-term weakness driven by maybe weaker exports, let's not forget that I think if we look at Asia as an investment geography, then there are still positive drivers that can be rewarding for investors.
Okay, we are going through the markets, and then we'll look a little more closely to maybe to Singapore, and if we can look at small to mid cap. But why don't we take a question, just in case as we go along, we don't have enough time. What's the optimum investment allocation of sector while we are taking advantage of the growth in Asia? So investment allocation optimal because of the growth in Asia. Anyone wants to take a step?
So this is in terms of allocation to equity.
Yeah, so it will be allocation of sector allocation.
Yeah, so it's equity. So as I said, I personally hold a view that we're going into a slower period, and so we're not going to be investing in a very aggressive way. In other words, I don't think it's time for us to take a very aggressive stance in our personal investments, right? And anyway, if you think about the bond markets today, they do offer you pretty high returns, even though it's very volatile. But it offers you quite high returns, especially on the treasuries, for example. So, if you compare that treasuries with the equity markets, then, it's natural that you move your money more to the riskless segment. But in any case, because you want to take a more cautious stance, I would advise that your allocation is more towards the dividend incomes type companies, the ones that are more recurrent, the quality companies, and the ones that have low valuations, right? The high growth, the super high growth companies already have devalued quite a bit on NASDAQ, for example. So that's one where, maybe you can start, but it's going to be very cautious. So my stance is more cautious but start investing cautiously and build up your position from here. In terms, yeah.
I think we can amalgamate with the top left, as everyone can see. The sector allocation, but considered as safe haven. I think you can combine these two together.
So things like your recurrent income type companies like consumer names, utilities, healthcare. These tend to have fairly recurrent income.
Guys, safe haven sector allocation. So Paul, you said REITs, right, just now? So I presume that would be a good safe haven.
In terms of, just to deviate, in terms of asset allocation, the 60-40, just a reminder, I'm not sure who created that, but anyway. But for sector allocation, I think the best if you're not clear, if you can't really differentiate yourself, just buy the index Of course, buying index is like you go to the chai fine, just eat everything, and just give me everything. But if the other way to kind of play the sector is just buy which sector has the worst headlines. And like now, what has the worst headlines? European banks is the worst headline. So you are a opportunist investor. That means you know nothing, but you know cheap price. That means when prices are down, then you come in. That's another way to play if you are not that familiar.
Paul, the question was safe haven. And you
okay. So I thought you were talking about sector.
And you told us to go maximum volatility.
Okay.
We stick to the question, then after that we go to big
safe haven is almost like a no-brainer as government, right? Like there is the ultimate safe haven. But even that also has issues like Silicon Valley Bank is safe, but your interest rate is not safe. Your interest rate risk is still there. But it's obvious anything related to the government, anything related, well, I shouldn't say anything more. Yeah, but anything related to a sovereign rated instrument would be the safest asset.
Brilliant. Gerald?
So I think REITs will be definitely one of the sectors, but I think even within REITs, we need to be mindful towards those that do not have too much debt. I think in this environment where the interest rates remain high, that is one criteria that we look for across different companies, and that would include the REITs as well. Maybe one asset class that has not been mentioned would be gold. That is a question that we often get around, given the market volatility, would gold be a good volatility hedge? We have seen gold prices going up quite a bit over the past week. And even on the SGX, there'll be ETFs that you can get exposure to gold as well.
Okay, wow, we're getting quite a lot of questions. So I think the audience doesn't want me to go to my set questions. Okay, so we just take what's on the screen. Yes, please, Pearly.
Commodities as well.
Yes.
So maybe if you have a longer term view as well, you want to think about the big structural trends in the world today. And I'm sure that many of you can come up with a list yourselves, but we do know some of the big pervasive trends, right? One of it is the supply chain movements, right? In the 1980s till of recent history, China was the manufacturing base of the world. But today, obviously, that's going to be diversified away to other countries. And I do believe that the ASEAN countries and Asia, will benefit from being the manufacturing alternative to China, a very credible manufacturing alternative to China. The other thing is also Singapore as a financial center, right? You've got all the issues in the US banks and in the European banks, but Singapore has proven to be quite resilient. We've got a very robust regulatory framework and a very, a very trustworthy regulator and very on-the-ball regulator, right? So, people do have faith in the system. And in terms of geopolitics as well, Singapore is kind of like your neutral ground, right? So I think Singapore will benefit from still the flow of money into the private banking sector, into the finance area as well. So I think these are big structural trends. I can talk a bit more about others, but maybe I'll leave it to the panel.
Okay, so several questions talking about promising sectors, but one common word is ASEAN, Asia. So maybe we can take that now, bring it closer to home. Promising sectors in ASEAN and Asia, and or in Asia that we can focus on.
Okay, so like what Pearly mentioned, what we do notice is that at least mine is mainly Singapore stocks, is that for the semiconductor stocks listed in Singapore, ASEAN is definitely the destination for a lot of semiconductor equipment companies. So although the cycle is down short term, but what has different now is that a lot of the semiconductor companies have found either new customers or expanded the product range. So what I'm just trying to say is that when the cycle bounces back up in semiconductors, you're going to get an additional boost because they widen. Like you're talking about LAM, Applied Materials, they're all here now, not only in Singapore, of course, also in Malaysia. So I think that is one thing that we see across all the semicon companies that are listed here. They have new programs and very clear new programs, just that it hasn't started because the market's a bit soft right now.
So I spoke a bit about China's reopening earlier. So I think linked to that would be the tourism sectors and companies that can potentially benefit from this increase in tourist arrivals. In Singapore alone, the Singapore Tourism Board expects that there'll be 12 to 14 million visitors into Singapore this year. That'll be close to double what it was last year. We have yet to even see all the Chinese tourists coming back to Singapore as yet, but I was just at Lau Pa Sat having breakfast earlier. You already see that there are a lot of tourists and driving consumer spending within Singapore. I think apart from that, the consumer sector still continues to be very strong. It is resilient in a slowdown, but I think generally we have seen that the employment numbers are still healthy, and that is driving some of the consumer demand growth across the entire region.
Okay, there's one with 5 votes, so I think we should pay attention to it. Top left, beginning of a lost decade, similar to 97. So we should switch to T-bills to cash. In other words, safe haven. I think we've touched a bit. So just to address this, do you have anything else to say?
Maybe just to add to that, I think generally diversification is still the key principle. Even if you want to be switching to something that is seen to be effectively risk-free, like a T-bill, I think what we would generally do is still think about diversification, both in terms of your exposure to government-related bonds. This can be done through various ways in that, apart from looking at T-bills, there'll be Singapore savings bonds as well. I think even within T-bills, you don't want all your T-bills to be maturing in 6 months' time, and then you have all the money coming back to you and unsure where to invest. So I think diversification across different asset classes will still probably be a good way to go ahead.
Okay. So far, Asia, ASEAN, but in general. So if I were to ask you to, pinpoint, that will be the top left question again. Can you speak about a specific country, specific market? So any particular market in ASEAN, given our region, highest growth. So I suppose, pin down, maybe countries?
I'm not familiar with no specific names, and you probably have to do more due diligence and personal work. But one area that I'm familiar with from a top down is on the metals and mining space. And clearly, if you think about the energy space, in the past, we relied on the liquids and the gas, oil and gas, right? But going through the next 30 years, that's going to convert to the metals, right? You need metals to make batteries. What are the metals that you need? You need copper, you need lithium, you need graphite, manganese, nickel. So these are very important metal groups. And if you think about the level of underinvestment, it's very, very high. I think if you go YouTube, you go and read about EV metals, you realize that the sort of demand that's required in that space would probably be multiples, not in the factor of 2, but 5 to 10 times sort of level. So there's a lot of investments that will have to go into that space. And there's a general sense that it is very slow. So Indonesia could be a country to look at because they are quite metal rich. Similarly, Malaysia as well, to a limited degree. They do have some rare earths, and I think even recently there was gold found in Malaysia. So I think, some of these things bear more research and also more attention to the EV metal space. Yeah. So Indonesia, I believe they do have a new IPO coming out in the nickel space. Yeah.
Oh, okay. I guess the question is the beginning of lost decade. I think probably maybe a golden decade for ASEAN, because if you look at all the foreign direct investments, it's record high for most of the ASEAN countries, and this is before China. So just imagine when the first destination the Chinese businessmen will come will be ASEAN. I don't think they're going to US. Maybe they can't even go, but anyway, they're not going to go to UK, they're not going to go to Australia. So the first place every businessman is going to hit, it will be coming into ASEAN, and they will come to Singapore first, because they will start with Singapore. Of course, there are other reasons, but most should be coming here to start new businesses. Even in Malaysia, you can see a lot of investments. So BD had our 97, so maybe it's for other people to have their 97. So maybe, yeah. Should we switch to cash? Cash is a very competitive asset now. It used to be nothing, right? But taxi fare probably more than your interest you get. But right now with interest hitting 3-4%, it's a very competitive asset, especially Singapore with strong currency, and you have the optionality to come back into the market. So cash is I shouldn't talk so much about cash. I'm doing equities. Yeah, but anyway, cash is quite competitive, not that competitive. Yeah. So your optionality, you got Sing dollar and you got return. Wow, so tough. Yeah. Okay.
I think if you look at the macro as well, so much is related to the confidence of your system, and your confidence of the system then moves to the confidence of your currency as well. And we have seen, huge volatility in currencies. But I think in general, the Asian and ASEAN currencies have held up quite well. And the reason for that is because, as Paul said, we've learned our lesson through the Asian financial crisis as well as the great financial crisis, where, the bank runs and issues with bank balance sheets and so on. And we haven't seen those issues in Asia, partly because we do still have a very high savings rate on a personal level in Asia, and governments if you look at the debt to GDP of the Asian countries compared to the developed world, and by Asian countries, I mean ASEAN, Singapore, Hong Kong, not necessarily Japan, which is quite highly indebted. But, these countries tend to have debt to GDP below 100%. And so, that governments do have the capability to spend. And because debt to GDP is low as well, your currencies tend to be stronger, firmer. And I think that's so important today in this climate where you've got all this topsy-turvy, geopolitics happening that affects your currency as well. So having a strong, resilient currency is very important.
Okay, so far, lots of talk on cash, safe haven, REITs. Bottom row, second one, Paul, I think you like this because you wanted to tell us to buy junk bonds, right, just now? No, was it? As a retail investor with mid to high risk profile, so in other words, rev up the gear a little bit, not looking at so conservative. The two votes, the bottom second one from the left. As retail investor with mid to high risk profile, okay, how do you rock and roll? What sectors should we look at?
This one I must say very softly. You don't underwrite anything. So I think if you high risk, like we said, just go for the worst headlines. Where is the worst headlines? Europe. So there are ETF, there are European bank ETFs. If you are very aggressive on bonds, like a TLT, it's a very long dated bonds. If you think rates are coming down, that is where I would go if I'm a retail, right? Because how are you going to analyze the company? Where do you have the time? So you just see who is the worst, because everything's not everything, but it's already priced in. The risk is already priced in. Everyone knows there's a bank run in Europe. Like, again, using the auntie I spoke to. So say,
why always auntie? Where's the uncle?
Okay, but what I'm saying is that as a retail, that is your advantage. I think Pearly knows as a fund manager, you have to be always invested because cash is your enemy. So when it's down, you also have to invest. When it's up, also have to invest. But retail has that advantage, which of course most people don't. When prices are down, the retail instead start to run away. Yeah.
As they say, if it goes onto the front page, it's time for you to go the other way. So if it's in the middle of the page, maybe you wait. Once it goes to the front page of the magazine or the newspaper, then you think about being a contrarian.
And maybe apart from banks, I think the other sector that was very badly hit would be tech as well. We've seen a lot of the tech stocks actually come off very significantly. If your view is that they still have the structural growth angle coming from digitalization, they have taken significant cost cuts to actually improve on their cash flow generation. If interest rates have actually peaked and that this higher interest rate will no longer affect their valuation, then some of these tech stocks might be worth looking at as well.
Okay.
So high risk, you could also think about the deep cyclicals. So by deep cyclicals, I mean stocks that, have losses or profits that are like 5-6 times, right? So the cycles tend to be this way, right? And so you might want to think of some of these sectors like the shipbuilding sector, the oil rig sector, oil and gas to some extent. These are very deep cyclicals, and if you have a 5-year view, you tend to make multiples of your money if you have a 5-year view, 3 to 5-year view, because the cycles tend to be very long. And I do think that some of these, even semiconductor, do have signs of cyclical troughing.
Okay, there is a fellow investor who is still a bit, level-headed when it comes to investing. He asks, that will be the last row to the right. When are REITs expected to recover, given elevated interest rates in the near future?
Well, it's very hard to, like I say, it's very hard to time the exact, because as you can see now, the noise is on interest rates, the direction of interest rates. We know that the direction of interest rates is likely either mildly up or coming down over time, right? So it's hard to tell. And then in the meantime, you might have the economic slowdown, right? So REITs are under pressure because of all this sentiment. So I feel it's quite hard to time. So, it for me is just, if you think that the valuations are extremely cheap, and some of them are extremely cheap now, it's time for you to start to accumulate slowly. But just be aware of some of the pitfalls, one of which is look at the REITs and their refinancing cycle, because it's quite important. If you know that they're going to have bonds due, very soon in the next 1 year, and their average interest rate today is 2%. And when their bonds are due, their financing is due and they need to refinance at 4% or 5%. That's a very big difference. So you need to understand that. Either talk to your friendly analyst, Paul, or, do your own due diligence. Yeah.
So I think for the REITs, Pearly mentioned one of the important points, which is the borrowing that the REIT actually have. I guess the other significant concern for a lot of investors is how will their leasing activity be impacted by a recession. So I think we can also look for some of the REITs which have got more resilient assets. And I think in this area, the retail REITs are generally seen to be a bit more resilient compared to something that might be more cyclical, like your office REITs.
I guess most REITs always say they are hedged for 3 years. It also means they got headwind for 3 years. So just bear in mind, that means 1/3 of their, so every year 1/3 of their loans have to gap up to the higher interest rates. So there'll be like a headwind for them for 3 years. So like we said, don't expect any growth from the REITs. But again, if the macro environment has changed and rates are coming down, then by default they should be a beneficiary.
Right. Okay, a little different flavor, bottom left. This on SPAC. SPAC is, it came out together with NFTs and when cash costs almost nothing. Your view on SPAC. By the way, SPAC, this was listed, like I think a lot of them came out in 21, mid to the end, and they are required within 2 or 3 years to find a target. It was blank check listed company, so you gave them money in the hope that they'll find a winner. They're supposed to find winners very soon. What? That's a chuckle of cynicism, is it, Pearly? Okay, but I mean, now rates have gone up, cash is expensive. It's the antithesis of why SPAC existed, the opposite of why we had SPACs. So what are your views, guys?
The only good thing about SPAC is you're covered at $5, at least MAS protect you. The last comment for SPACs for me is dying is present tense. What's past tense of dying? I'm not sure.
Past tense of dying is died.
Yeah, that's it for me.
Yeah, I think Paul mentioned a good point, which is that you actually have the ability to redeem your SPAC based on what the NAV of the SPAC actually is. So I think for some investors, if you think that you have like too much of T-bills, you can also look at SPACs potentially as a yield instrument. If the SPAC is trading at like $4.50 today, if you are able to redeem it at $5 in 1 year's time, if they're not able to find a potential target, that can potentially be a way that we are looking at SPACs as well, apart from the acquisition angle. It needs to be in an escrow account.
Yeah, but if you want to buy, SPACs usually buy loss-making, but so if you want to buy any loss-making, I got a lot of companies to recommend. Yeah, we can talk.
And your mobile is? Okay. I think, we kind of You had done nearly everything on the TV. I'm kind of annoyed because I spend a lot of energy with my set questions, and he's coming for me already, so there's no time. So what's left for me to do is to thank Pearly, Gerald, and Paul for the insightful remarks. And you notice I have the easiest time on stage, right? I just fire questions. My name is Matt. Thank you very much, everyone. Thank you.
Thank you to our panelists and our wonderful moderator.